Netflix is down 70% from the all-time highs, placed back in October of 2021 at nearly $700 per share. The stock took the elevator down to lows of $165 per share, with a recent rally back up to $200. This is a typical growth stock story where once the growth stops or slows, Wall Street then dumps the stock viciously, which is exactly what happened with Netflix, and the reason why we are down to the market cap of $89 billion and a PE ratio of 18. That being said, the goal of today's video is to determine whether or not Netflix is a value investment for the future at this current point, no matter what the economic outlook is today, and to determine where Netflix might go from here, whether it's approaching a margin of safety, or if we should completely disregard this business. Stick around to the end to find out, as we'll be talking about that and more on today's episode. How's it going? Welcome to Everything Investing. I hope you're having a great day. With that being said, today we're going to take a look at Netflix's Q2 2022 earnings results. We'll do a deep analysis into the financials, the success of the business model, the latest news, and then we'll conclude with the valuation of this business to see whether or not this is something we as retail investors should add to our portfolios or not. And if you enjoy the analysis and the value investing perspective, please like and consider subscribing for more of this content. So we all know Netflix, the world's leading streaming entertainment service with over 220 million paid memberships across the world, actually in over 190 countries. And they're doing extremely well, especially in the US, where they are the clear majority of the US TV minutes viewed. What's interesting is if we actually compare their minutes to their competitors, to their streaming competitors, we can see the likes of Disney Plus, Amazon Prime, Hulu, and Apple TV. They're actually much lower and they're outweighed by Netflix's total viewership, which is a great sign for Netflix investors. Additionally, we can see more proof of this where we see the cumulative Twitter volume for their new release of Stranger Things Season 4 massively outweighed Disney's Obi-Wan Kenobi and the movie Top Gun. However, you have to take this graphic with a grain of salt, as this is just the poll taken from Twitter in terms of the volume. Now, despite the fact that they are the world's leading streaming service, they have been seeing a recent decline in viewership and memberships. And in the near term, their priority is to reaccelerate their revenue growth and to improve their monetization. One way they're planning on doing this is by acquiring businesses such as Animal Logic, which is an animation company, which will help accelerate the development of their animation production capabilities and reinforce their commitment to build a world-class animation studio. So it's clear building on their animation production is one of their goals, and they're going to fund this acquisition through their existing cash balance, which we'll get into in just a moment. Additionally, they're looking to launch a new payment plan that actually will be reduced fees. However, there's going to be some advertising introduced into them, as they recognize that they have been increasing prices year over year, so they really want to give the choice to the consumer. And they're looking to target this launch in early 2023. And this should attract more users to join their platforms and or pay for their subscriptions. Now that's good. However, the biggest issue that Netflix has faced has been the increasing cost pressures that they have to pump into contents and producing contents over the years. However, we have seen actually a decline recently, and Netflix has stated that there should be a decline going forward from 2022 onwards, and these costs should actually continue to subdue over the years from 2022 onwards, and that is the goal for Netflix. However, saying it and doing it is two different things, and the reality of the situation is you're going to want to see better content each and every year, and that is going to cost money. So we will see if Netflix can hold true to this promise. But if they can hold true and you are an investor of Netflix, the share price of this stock should massively increase, as you'll see in just a little bit. They do spend quite a bit on content. So if they have the opportunity to lessen those costs, they're definitely going to profit on the back end from this, and the share price should increase massively. Now, on to the income statement. We see revenues have been increasing quarter over quarter, which is very good. So have their costs. So after coming in with about $8 billion in revenues, we only have about $1.5 billion in operating income. Deduct some expenses and some taxes, and we're at, again, $1.4 billion, which is slightly down from last quarter's $1.6 billion. But they did mention in the report that this decrease quarter over quarter is actually due to the currency pressures that are currently going on in the economic environment. That being said, they came in with earnings per share last quarter $3.53, this quarter $3.20. So keep that in mind, as we'll be using these for our calculations later on in the video. And again, on a 6-month basis, they're pretty much flat year, quarter over quarter. Okay, looking at the balance sheet, we have about $6 billion of cash sitting on the sidelines. They do have about $32.5 billion worth of content assets, but it's kind of hard to evaluate how much exactly these contents are worth. They have $14 billion of debt. It's not too big of an issue, but I would like to see this cash position to be a little bit stronger here, but it is not an investment deterrent from this point. Now onto the statement of cash flows here. We drag down our $1.4 billion in net income. Again, We have to deduct for their additions to their content assets, add back in amortization, depreciation, stock-based comp, etc., etc. We get down to $100 million in operating free cash flow. They have about $90 million in capex, and that leads us to our free cash flow figure here of about $12 million. So it's not much they can really do with this $12 million. Last quarter, we were actually at $800 million in free cash flow. This quarter down to 12 million, so it's not that great. And actually the quarter before that we were at 175 of cash outflow. So yes, it's hard to evaluate what exactly is going on with Netflix's financials at this current point in time because of the inconsistencies here, especially on their bottom line. But nevertheless, what did they spend the 12 million on? Well, they actually didn't. Instead, they actually issued some stocks, so they diluted their shareholders. But this is probably a good thing considering the economic environment. It's probably good for them to have more cash on hand, and they did make an acquisition as well. But that being said, guys, let's actually jump into our calculator here and make an evaluation on Netflix's business. All right, so looking at our calculator here, if we input Netflix's earnings, and again, for the first 6 months of the year, they came in with about $6.70 in earnings. So if we extrapolate that out for the rest of the year, we can estimate on a balanced probabilities, they'll reach about $12 in earnings per share, which is pretty strong. With a required rate of a 10% return, they don't pay a dividend. If they can consistently grow at a rate of 12% for the first 5 years and then drop down to 5% after that on a 20 PE, they're actually probably fairly valued right now for a 10% return, sitting at around $201 currently, right? If they can actually grow on their earnings and actually grow at about 18% per year, 10% for the 5 years after that, and then 25 PE for 2030, then we can actually expect this stock price to be up towards 426. However, if they can't grow and their growth continues to slow, then it gets down to about 5% for the first 5 years, and then 2% for the 5 years after that on a 15 PE, yeah, we'd be sitting at about $105 per share, which means once again, the stock would be halved. But that is the risk and reward with Netflix, because when the growth is good and continuing to prosper, as you can see, the returns are lengthy. However, once the growth stops and they start to lose subscribers, growth slows down, you can see this thing falls off a cliff. And this is exactly what happens time after time with growth stocks. So you're going to want to see, can Netflix continue to grow on their subscribers going forward? Can we see some more growth? Can we see some more consistency in their operational cash flows and their free cash flows? And then again, can they start to slow the content spend down? Because that will really impact the bottom line results, and the share price should continue higher. But that is all for today's analysis of Netflix's Q2 2022 earnings results. If you made it this far in the video, please hit that like button and consider subscribing for more of this content. And with that being said, I'll see you on the next one.